Outlook for mortgage for the year remains unchanged. In the collection segment, the macro indicators continue to suggest an increase in business activity in the near future. U.S. credit card delinquencies continue to rise and were at 2.43% versus 2.25% last quarter. Charge-offs were 2.9 versus 2.54% last quarter, the sixth consecutive quarterly increase post-COVID. Similar trends are seen in the latest earnings of the large U.S. banks. Normalizing for higher seasonality of Q4 of fiscal 23, we are seeing encouraging trends in this business. We maintain our assessment of gradual recovery in this business through the year, especially in H2. The early stage collection segment will start to reflect this sooner than the legal collections, which would see an uptick from Q4 of this year or perhaps even Q1 of next year. We continue to make good progress in acquiring new clients and cross-selling into our existing portfolio. In this quarter, we added 4 new clients. Last year, I spoke about our intent to diversify BFS into other segments beyond cards and the mortgage industry. One such area we identified was expanding in the auto finance segment. We are seeing green shoots of success and have added 2 new clients and expanded 3 existing auto finance clients in this quarter. On the UK BFS, performance remains strong. However, the pace of growth is slower than last year due to a combination of lower volumes across the industry given the challenging economic environment and some movement from on to offshore, which I earlier alluded to. We've added new lines of work across our key relationships, including expanding to collections, as I mentioned a minute ago. Also, the trend of increasing usage of chat instead of calls, service offshore continues nicely. Overall, we are pursuing several new ramp opportunities within our existing client set in UK, for which we expect quick closure. These should further augment our growth in H2. For BFS, in summary, our outlook remains steady. We're making good progress in diversifying into newer segments. We already seen success in auto finance, and we are now focused on expanding our DECX or the digital call center and FinCrime ops capability for the US bank segment. 36 to healthcare. This segment remains steady. Year-on-year growth was flat in constant currency. As previously discussed, our provider business has been impacted by the public health emergency promulgated by the US government at the start of COVID. After nearly 40 months, the PHE was finally lifted in May 23. The headwinds from Medicaid, auto enrollment, re-enrollment, etc. have now subsided, and we expect deal activity to pick up meaningfully. We expect growth in the business to emerge from H2 of this fiscal as different states and health systems start dealing with the new reimbursement environment. Expanding offshore capabilities in the provider has been a key focus as we build adjacencies. We are pleased with the progress thus far. We've added 1 new client and 1 existing onshore client for offshore in this quarter. And while these will scale gradually, it will help us create strong referenceable case studies to help accelerate the offshore growth within our existing client portfolio. In addition to this, our overall deal pipeline remains healthy and we are witnessing an increase in business activity. Beyond the new offshore clients, we've added 2 new clients this quarter. In the HPSS segment, we continue to witness a slower than expected scale-up of volumes in our recent wins. These delays, coupled with the onshore to offshore movement in some of our processes, are resulting in near-term softness in the HPSS business. We strongly believe this is transitionary, and we are confident of getting growth back as we saw in early parts of last year in this business. To zoom out, our HPSS growth thesis is based on landing and expanding top 10 health plans, expanding our digital intake offering, and building BPAS for the mid-market. We continue to make excellent progress in penetrating and growing top 10 health plans. About 18 months ago, we talked about a digital intake win with a top 5 health plan in the US. We have since closed 3 additional engagements with this client and have a strong pipeline targeted to close for the rest of this fiscal. The client rates us as a strategic partner, and this account is now on track to become a top 5 account for the HPSS practice. This quarter, we added a top 20 health plan to our roster with a significant digital intake win. This deal should add meaningful revenues once fully ramped up. And more importantly, a strong execution will pave the way for expansion in other functions for this client. The pipeline for digital intake is strong with 4 active opportunities in play with new and existing clients. The progress on this strategy, the YTD wins, and the pipeline give us the confidence for a strong growth for HPHS in H2. Overall, for healthcare, to reiterate, we are focused on reversing the revenue decline in provider and growing our share of wallet across top 10 health plans in HPHS while strongly executing on the DI opportunity, the digital intake opportunity. We're confident in achieving both these goals. Shifting to CMT, this segment saw 7% YOY growth in constant currency. This is notwithstanding the onshore to offshore movement in our top client relationship. As I mentioned earlier, we've extended the contract with the top client for 10 years. This is a great validation of the working relationship between us for the last 22 years now. Considering the strategic priorities of our client, we are actively balancing their delivery footprint across onshore and offshore to offer the most cost-effective solution to their needs. Outside of the top client, our growth traction remains strong. In a short span of time, we have made solid progress in scaling our EdTech practice. During COVID, as we know, the EdTech companies disrupted the way learning was consumed globally. We saw this as an opportunity to target these companies and help them build better learner experience UAVs. This is a white space opportunity. We are creating and delivering offerings that enable both traditional and new age EdTech companies to focus on providing greater learner experience to improve both stickiness and learning efficiency. We've designed journeys for end-to-end learning and have implemented tech solutions, including GI-based solutions to provide better access and experience. Our consultative approach has enabled us to win large analytic deals that are truly transformative and a referenceable case study for the largest CX go-to-market story. As we speak, we are finalizing a contract and commence hiring for sophisticated operations for a strategic EdTech client. We estimate this will add between $15 to $18 million in annual revenue, and we expect to go live in Q3 and ramp up by Q4 of 24, latest by Q1 of 25. Finally, I would like to comment briefly on the guidance for fiscal 24. We remain confident in our revenue growth guidance of 2 to 5% for fiscal 24 with an operating margin range of 11 to 12%. This revenue guidance continues to include a headwind of about 3% from last year's base effect in the market business and a headwind of 3.5 to 4% from the onshore-offshore portfolio rebalancing. Let me now hand over the call to Dinesh to give an overview of the financial results.
Thank you, Vipul, and good morning, everyone. Here is quick snapshot for financial for the quarter gone by. Revenue for Q1FY24 came in at 15,292 million in rupee term and $186 million. This implies an year-on-year growth of 3.9% in rupee term and a decline of 1.6% in constant currency terms. On the margin front, operating margin came in at rupees 1,789 million or 11.7%, which is up 52.8% year-on-year. Profit after tax came in at rupees 1,260 million or 8.2% of the revenue for the quarter, which is up by 48.1% year-on-year. Vipul talked about the extension of the contract with the top client. It is a great outcome for our continued relationship with the client. With part of businesses moving offshore, we should start see margin expansion gradually as the transition completes. For this contract, we'll be making an investment of about GBP 15 million. Of this, GBP 9.5 million will be paying in this financial year and balance will get paid in FY25. The total contract acquisition cost will be amortized over the contract duration of 10 years. Some other financial highlights. DSO came in at 63 days versus 60 days last quarter. Net debt stand at rupees 7,133 million as of June 23 versus 6,159 million as of March 31st. increased due to the higher working capital drawdown this quarter. This also led to the higher interest payout for this quarter. On the cash flow from operation in Q1 was lower due to annual bonus payouts, higher receivables, and the first tranche of the payment for contract acquisition cost, which we paid in this quarter. We expect these to be normalized by next quarter. Our cash balance, including investment, stood at 2,207 million at the end of the quarter. Tax rate for the quarter was around 18.9%, which is within the guidance range of 18 to 20%. On the forex front, we have coverage of GBP 59.9 million for the next 12 months with the average rate of 102 rupees to the pound, and coverage of $72.5 million with the average rate of rupees 84.1. For next 12 to 24 months, we have coverage of pound of 56.9 million with average 7 to the pound. And dollar coverage is around 2 million with average rate of 84 rupees. And for more than 24 months, we have coverage of pound 46.4 million with average rate of 111.6 to the pound. In addition, we also taken some of the option products to increase the better realization on these rates. Let me also introduce Pankaj Kapoor, who has joined us as the Head of Strategy and Investor Relations this quarter. He comes with our 25-year experience across corporate and financial markets. Please join me in welcoming Pankaj, and I know he is looking forward to getting to know all of you in the days ahead. This is all from my side. We'll now open up for the Q&A.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Mohit Jain from Anand Rathi. Please go ahead.
Sir, first, good quarter overall. The first question is related to the extension of the contract. So one was on the margin front. Now that this is moving offshore, how much impact or benefit do you think you should have while we do our calculations on margins on the overall deal in the context of the payment that you are making? And a similar question, but not related to numbers. How do you, because you have already spent a lot of time with the top client, how do you get to sort of sign such large deals, say 10 years or something, in the current environment?
Okay. Hi, Mohit. So look, the Sky movement, and as you said, there is an amount of payment that we are making as sort of the investment in the deal. After amortizing for that over the deal term, starting from this year, this deal will be both will be margin accretive as well as EPS accretive. The movement, so it will kind of be healthy margins getting added to the bottom line. How do we sign such large deals? Obviously, look, the percentage of work we do for them is a big chunk. This is a long-term relationship that has been built bit by bit across the value chain and across product lines. It's a collection of 4 or 5 product lines that we cover. A lot of them are managed sort of reasonably independently while there is governance at the top level. And to that extent, as they think of their long-term plans, right, they take a long view, right? So even this negotiation and the fact that we'll kind of do this offshore has taken us a while to kind of think about it, right? It didn't happen overnight. They tested for a few things gradually, and we reached this point after several, a longish period of sort of working through the details. So the strategic outlook that they looked at for the work that we do for them, I think that is what gives the runway and the confidence to take a long-term view of the deal, right? And given the fact that we've already worked for 22 years, it gives the confidence that, hey, I can take a 7 to 10 year view of this deal. Even otherwise, right, the large strategic deals that we are signing, as I guess most of the industry, we are looking at a sort of 5-year plus extension sort of outlook. So to that extent, for large strategic deals, I would say this isn't unusual.
Okay. And in terms of revenue, like we saw the slight drop in revenue in this quarter. So I'm assuming that is on account of the offshore shift that you spoke about. Now, from going ahead standpoint, is that shift more or less done? Should we expect some more decline in revenue from top client? Where is it likely to stabilize?
Sure. Your question on the revenue decline was overall or just for the top client?
For the top client, because overall will come a little later, but on the top client side, because you are also talking about some shift towards offshore.
Yeah. So that journey has started in Q1. That's kind of a big reason why we've seen a decline. There was obviously some softness in volumes as well. As I mentioned, the UK volumes or the UK economy is going through some softness. So both factors combined. However, I would also say that a big chunk of the onshore to offshore movement will come through in Q2 and Q3. And then kind of, as the current plans, then it will stabilize. So we expect the top client revenue to decline over those 2 quarters on top of what we saw in Q1.
Right. And a related question is like if they are looking for that decline, which I assume will impact the telecom vertical or TMT vertical growth at the company level, and your guidance suggests sequential growth from here on. BFSI, you spoke about some softness in UK. So which vertical are we really positive on here to deliver a company level growth of say 2 to 3%?
Yeah. So we do expect growth from this point onwards, after baking in this decline that I talked about. We expect good growth from our CMT segment, other parts of CMT. So for instance, I talked about the large deal in EdTech that we have signed. That will start to go live in October and slowly build up steam for the rest of the year. HPHS will be a good growth driver given what we've signed and what's under implementation as well as coming up to closure there. So these will be the 2 relatively chunky growth drivers. And if I look at the other 3 businesses, collection, mortgage, and provider, the big businesses, all of them have had varying levels of headwinds and sort of volatility up till now. That headwind, I think, for most of them are pretty much gone now. In fact, some element of tailwind building up for collections. We'll see how the mortgage kind of builds out. And then the big friction for provider, which was the PHE, etc., is gone. So I think we'll expect steady growth in all these 3 segments. So that's kind of the environment that we look at for us to kind of get confidence on sequential growth from this point onwards, leading up to the guidance that we give.
Right. And last is on margins. So we have done, say, guiding for, I'm taking the upper end for convenience, say we are close to 12% odd. Now, as you mentioned, business is stabilizing. Where do you think we can operate in a steady situation given that offshore shift is likely to increase for the company? Because historically we have been in this range at the EBIT level for quite some time. So do you think there is a chance that your margin structurally may go slightly higher versus what we have done in the past?
So for now, we're keeping the 11 to 12% outlook. We have some investments also lined up, given GI and other things on the horizon that we need to kind of play with and kind of stay on top of. As I've been saying historically, that outlook remains unchanged, that once this year kind of gets to a steady state, we should start to see that 25-30 bits improvement year on year. That still remains the medium-term goal. And I think at this point, even with this offshore shift, we'll continue to look at sort of rebalancing the portfolio, right? I've been talking about growing other nearshore locations, Philippines, Mexico City, South Africa. That's our focus, to continue to grow that portion of the portfolio. But for now, the margin outlook is sort of this 11 to 12%, and then from that point onwards, improving by 25-30 bits a year.
As a follow-up, so the nearshore locations you count in onshore when you report the percentages, or is it counted as offshore?
They counted offshore.
They counted offshore. Okay. Great, sir. Thank you and all the best.
Thanks, Mark.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 3 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. We'll take the next question from the line of Manik Taneja from Axis Capital. Please go ahead. Mr. Taneja, I have unmuted your line. Kindly proceed with your question.
Audible? Hello?
Please proceed, sir. Yes, sir. You're audible. Yes.
Hello? Am I audible?
Yes, sir, you're audible. Please proceed.
Yes. So thanks for the opportunity. Vipul, I had a couple of questions. Question number 1 was with regards to the consolidation that we've seen amongst the mega customer care companies in the course of last 12 months. How do you think this impacts the landscape for mid-sized players like us? That's question number 1. The second question was with regards to the significant offshore shift that almost the entire customer care industry essentially has been talking about over the course of now 12-15 months, and we are seeing this change significantly. How should we be thinking about our margin outlook, given the fact that we should also be benefiting from such a significant swing in terms of offshore delivery?
Sorry, Manik, your second part was CC landscape change in the last 12 to 15 months from what technology?
No, so the first question was with regards to the consolidation that one has seen amongst the mega customer care companies.
Yeah. And what was the second part of that question?
And the second question was with regards to our margin outlook. Now, the sense that we are giving essentially is that margin expansion should be far more gradual, while from some of our bigger competition or bigger peers, we are seeing much more confidence in terms of margin improvement. So what's driving the status quo from our end?
Yeah. Okay. So the big call center consolidation that we've seen, or at least announced, it is interesting. These guys serve big volume industries, right? Tech, retail, communications, energy, government as well. And they run sort of global portfolios serving multilingual. And I think that race to kind of be bigger and better and serve all geographies, all languages, I think that seems to be the primary driver. As opposed to that, our primary focus is more niche, heavy domain-focused call centers, right? Whether it's healthcare, whether it's mortgage, whether now targeted parts of tech or edtech, the learner experience that we talked about. And even for our CMT clients, we work with a few, but we work across more sophisticated sort of client acquisition, retention, those kind of chains, right? Rather than just sort of the vanilla servicing. So I think we're talking slightly different markets there. Clearly, we don't operate at that level of scale or that level of multilingual capability. So to that extent, I don't think or worry about the impact from those big mergers. In fact, some of the conversation that we've had in the last few weeks with a couple of clients is that the larger clients, especially the mega clients, the tech ones, they kind of worry a little bit about the concentration risk such mergers kind of present to them. And to that extent, there might be some opportunity for them to expand their portfolio of suppliers so that they're not exposed to a few very large providers. So we'll see how that plays out from a concentration standpoint. On the margin, I think clearly last year was an aberration, right? We had the massive revenue shock from mortgage and the collections not kind of picking in like normally does. This year we come back to normal margin. Even with the move that we are talking about, right, with a large client and a couple of smaller clients in healthcare and BFS, if you look at our onshore-offshore mix, it is still broadly 70-30, right? Our intent is to slowly and strategically move our clients as well as new deals with a heavy offshore tilt, right? That should help the margin. As this movement starts and it starts to reflect on our results, we'll give you better guidance on sort of how we see that. But please do keep in perspective, it is still 70-30 onshore-offshore, while what you might be comparing with has very different sort of portfolio mixes. Okay. We do think we can eke out this 25-30 bits every year for now from this 11 to 12% guidance.
Sure. And just to prod you further on the margin outlook, from a segmental margin standpoint, we saw the big drop in terms of BFS margin through the course of FY23 and have seen recovery over the course of last couple of quarters. Should we see these segmental margins on the BFS side go back to the 17-18% levels over the course of next 12 months?
I don't know where they'll go up, but we'll definitely continue to see improvement. Clearly, as our mortgage volumes had dropped, there was a significant impact on their margin given the scale. We made great progress in the last 3 quarters, and we feel confident that over the next 2 quarters, we'll continue to eke out sort of more margin from mortgage. Even share of digital. And our diversification into banking is still relatively sort of young and nascent. Right now, it's all about market share and landing accounts there. We'll kind of deal with sort of margins once we have the critical mass there. But overall, directionally, we should see continued positive movement in the FSI margin.
Sure. And the last bookkeeping question was with regards to our healthcare business. We could provide a split of the HPS and the healthcare provider business both for FY23 as well as for Q1FY24.
So this quarter, we were at about 55-45, 55 HPHS, 45 providers. And for full year last year, we were, let me just pull it up for a minute. Our full year number was kind of in the same ballpark, maybe sort of a percentage movement here or there for the full year as well as for this quarter.
Thank you and all the best in the future.
Thanks, Manik.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. We'll take the next question from the line of Dipesh from Emkay Global Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First, just want to get sense about the new service offering, which we, I think, highlighting over last few quarters. So progress made on those things. First, about trust and safety standard offering, which is for content moderation, which we are highlighting for last couple of quarters. And second is fin crime, so financial crime operation. If you can provide some sense about overall market size, how we plan to play in these things, and what kind of, let's say, 3-year, 5-year kind of time horizon, scalability of some of these offerings. Second question is about the guidance asking rate. If you can run through us, what would be the asking CQGR based on 2 to 5, which we require for next 3 quarters. And last question is about the finance cost. Finance cost seems to have increased substantially quarter on quarter. So if you can give some sense, what led to that increase and whether it is here to sustain. Thanks.
Hi, Dipesh. Dinesh, do you want to answer the question on why the finance cost is higher this quarter?
Yeah. So Dipesh, I think finance costs have 2 components. One is that normal on a borrowing, the interest cost which we pay, and the second is on a accounting on a leases, because as you have facility or interest cost and the depreciation get split on the lease rental. So this year there is no material change in a finance cost purely on the borrowings. There is a borrowing increase, so there is a slight increase. Interest rate still remains between around 5% for our borrowing, so that not significantly changed. I think larger component is that as we are growing the offshore book, we have a new centers coming into, and that place when you do the capitalization of those centers, the interest component is higher in the initial few years and then it reduces. So I think that is the larger piece. But we see that next quarter onward it will be normalized, it will not be at that high level. Hope that answers your question.
Just on the number of center, let's say the way we report in Factsheet, India center and those data. it is showing one reduction rather than one increase. So from 11 now it is showing 10.
Yeah, so there is a reduction and there is an increase. So the previous old center which was in the process of going out, that has gone. So net is the decrease, but the overall we have added 3 centers in this quarter.
On the new offerings, custom safety is a big market, right? It has come up in the last 5-6 years, maybe a little bit longer. Varying estimates TAM of about 5 billion. Up until, I would say, 21, middle of 22, it was growing strongly, north of 20-some percentage. Obviously, since the tech slowed down in H2 of last calendar and this year, that growth rate has come down. But we still believe that the market is ready for maturity. It has done the first wave of offering, right, which was just pure content moderation. But now, beyond the big platform companies, we see the offtake of custom safety by a varied users and far more sophisticated and far more targeted usage of custom safety from privacy to ads integrity, and obviously even government starting to look at it from a different angles that they kind of look at it from a content standpoint. So we are still early in the game. We've come into a mature market, but we do think there is room. There is room to bring in a partner-driven or a tech-forward sort of solution there. We've had a couple of small but sort of symbolic wins, and we are kind of still building up our pipeline on this market. So still very early, but it's a long game. And as you said, if you take a 4-5 year view, the threshold generally, rule of thumb that we use is that if you're starting a new practice, in 5 years, we should see like a 50 million sort of outlook for that business, right? That's more from an aspiration standpoint. But we're still early in this game. And this year is a year when the TNS market itself is kind of relatively flat, as most tech companies have recalibrated their stuff. So I think this year will be a year when, existing players will be aggressive, deal making will be more price driven, and we'll see sort of how much we want to play and how aggressive we want to play out there. FinCrime, starting with banks and then potentially going to more the fintech-oriented payment products. That's a market which has grown really rapidly in the last 2 years. Earlier from an AML, KYC, and now increasingly from an online payment and a fraud standpoint. Our mainstay there today is an extension of our DECX offering, where from our call center experience, we're getting into more fraud-oriented, more specialized calls there. We've had great success in UK, where we work with now 4 of the top banks. And that offering is what we are now, as we kind of start to enter the US banking market beyond mortgage and collections. This is one of the more mature offerings that we are taking up and building the pipeline and interest in that market. I don't have very good estimates from different areas, but from what I've seen, the estimates for this market also range from between $2 to $4 billion. And there are a variety of ways in which customers are going from very heavy system plus kind of offering, right? Tech plus offering to more scale or more operational offerings where we're trying to play from a call center, which is identifying, solving, and even servicing sort of those related calls, and then working our way backwards into the left side of the process. So that's on that. And then I already offered comments that EdTech that we've been at it for the last 12, 18 months, we've had very good wins. And I think this large deal that we just announced kind of validates the thinking that we've had of entering this segment. And now we have a pretty healthy portfolio. Now some meaningful revenues as well to kind of play with and kind of take the next level of sort of GTM focus for this particular market. As far as rest of the year goes, we do expect sequential growth. We expect that Q2 will be relatively modest growth given the higher impact of the onshore to offshore. And from there on, the growth will accelerate into Q3 and Q4. That's how we currently model to kind of get to our guideline that we have.
Understand. Just one question about this EdTech deal. Now, if I look on non-top client exposure to CMT, it seems to be almost one-third of the revenue coming from this single client kind of thing once it start getting ramped up. So what would the mix in this non-Sky thing, if you can provide some sense? EdTech, obviously, whether it is fairly concentrated, it seems so far. But if you can give some color of which area we are and how we expect some of those segments to grow for us. Thanks.
So you think within CMT, what is the share of top clients? And then what are the other growth coming up?
Yes, the top client is obviously we report or we can calculate. For the remaining piece of the business, how it is divided?
The remaining CMT is, we have a growing, I want to say about I don't want to say one-third, more closer to one-fourth sort of U.S. portfolio that we have built up on that. This is without the EdTech, sort of the new growth that I talked about. Within that, there is a decent concentration of clients on the U.S. side. UK obviously is the big one and a few small ones. EdTech, once it builds up by Q4, I think we'll be in a better position to kind of tell you in the overall CMT scheme of things where it will land. But I think we need to think a little bit about this before I give you the answer. I can give you more directional answers, if you want to double click on any of that on the CMT side.
But maybe we can take it later. Thank you.
All right. Thank you, Tesh.
Thank you. The next question is from the line of Shraddha from MSEC. Please go ahead.
Yeah, hi, Vipul. Congrats on a good execution this time. Couple of questions. First is on the decline in the collections business that we saw. So can you quantify what was the extent of decline? Because we understand that Q4 is a seasonally strong quarter. From that base, what was the kind of decline that we saw in Q1?
Your voice faded off a little bit. I'll try to answer. Tell me if I don't. So elections, you know that Q4 is seasonally high quarter for tax. This fourth quarter was not as high seasonality as we saw in the past, but there was still an impact from seasonality. Legal collection is still taking its time to build up. There isn't a decline, but legal collection from where it was in Q4 to Q1, it was relatively flat. However, early stage collection, barring the impact of seasonality, was solid. Right, the new wins as well as the volume from big clients held steady. So if I take out the seasonality impact, we're happy with sort of where the core or the early stage collection landed. Did that answer?
So would it be possible for you to quantify the revenue for both the quarters in collections for us, Q4 and Q1?
We're starting to give more vertical level from this quarter or this year onwards. We're trying to kind of focus on BFS, healthcare, and CMT and kind of give you at that level. But happy to give you more qualitative comments if it helps.
Sure. And another thing is this extension of relationship with the top client for another 10 years. So does it come with any increase in commitment of annual budget from this account? And if yes, is it more because of they're shifting from in-house to outsourcing, or is it more as a result of share or wallet share gains from some other vendor that they have been working with?
Yeah. So, they obviously are a giant corporation in multiple businesses. At this stage, where we have started off is that there is no capacity reduction. It's the same capacity despite the movement that will run. Now, obviously, it's a very dynamic portfolio across product lines and across the life cycle from acquisition to service to retention to even collections in some cases, right? So in that life cycle, number of variables keep changing. From a strategic direction of how they run the business, obviously, they are also into a cost-efficient environment. As we've moved, they have also done some retooling of their core portfolios themselves. At this stage, we continue to expect incremental growth opportunities as we see it in the past 2 years, right? Some programs come in, some kind of as volume drop off or as campaigns get over, some volume go away. So we are fully on the table with them on every set of their annual as well as their quarterly strategic plan. There is no thematic at this point to say it will go up or down. It will be constant, and incremental growth opportunities will come as their priorities kind of change and they adapt to it. That's where we kind of understood each other's sort of business requirements and we'll play with it.
Great. And just last question. I know it's too early to call out the impact of generative AI, but a larger BPO company has called out that they expect a 20% cannibalization impact over the next 3 years because of Gen AI. So how do we see net-to-net Gen AI impact on our business?
Look, it's very topical. We don't spend a day these days without talking GI 5 times, and all of us are experimenting at home, and all of us are experimenting in businesses, right? From trip planning to how to make dishes to sort of how to respond to chat. I think personally it's very early. Market is still in the phase of testing out different things, of taking the technology and bringing into the enterprise world. All of us testing our pilots, and those pilots give us a point of view to say, if I take 100 people to do this chat and if I put GI, I could do this 80. So yes, we could get to those pilot level sort of, estimates of productivity or human either effectiveness or reduction. But to extrapolate it across the portfolio, I think that's a fallacy that we saw during the time of RPA launch as well, like 6, 7, 8 years ago. Everybody thought if you can get 30% in one process, you could get 30% across the entire operational estate, but that never happened. So I'm very circumspect of sort of giving that sort of estimate. But at this stage, everybody wants to experiment. New specialized partners are emerging every day who are bringing LLM specific to an industry, mortgage as opposed to collections, as opposed to healthcare, right? In the ring of the regulation requirements of each industry. So right now the focus is to test it out, see how it works, and then see how sort of how much materially you can implement and how much you can squeeze out. Also keep in mind demand keeps changing as well, right? With GI, our patterns as consumers will also change. So there is a demand side and there is a supply side effectiveness. Between the two, I kind of hesitate to make a long-term prediction yet.
Got it. And just if I can squeeze in one last question. In the healthcare segment, we reported a 4% decline. So is it more to do with HPHS or did we see some weakness even in the provider segment?
Provider was very seasonal. There were 1 or 2 programs which we knew will come to an end. So there was some decline from there. But thematically, as I said, provider seems set for sort of steady growth as market activities pick up and as more deals happen, we pick up. HPS had more declines. Again, partly some because of 1 or 2 accounts that were coming to the end of their implementation phase, especially the BPAS account that we had. And then there were some minor volume sort of corrections in one of the accounts. But it was more where we expected growth to come in faster. It's kind of running behind from a deal closure. That's kind of what's impacting it more. But yeah, more indexed to HPHS than provider for this quarter. Yeah.
Ms. Shraddha, does that answer your question? Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to the management for closing comments. Over to you.
Great. Well, thank you everyone for your engagement, for your great questions, and your continued support. So we look forward to coming back and reporting to you in a few months' time. Thank you again and have a great day ahead.
Thank you very much, sir. Thank you. On behalf of Firstsource Solutions Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.